Okay, Tony. I think we'll start, and
Thank
other
you.
people can join as they as they log in. So, thank you everyone for joining us today. This is obviously the second eScalate webinar that we've done. So, 2 weeks ago, I think it was now, we were talking about accessing finance. And our export today is our export. That's because I've just come off a webinar talking about export. I do apologise. Our
I
expert.
don't mind being an expert.
Oh dear me. Our expert today is Tony Hobbs, and he's come to talk to us about managing cash flow and forecasting. So a huge topic. I think even established businesses can always be learning, but there's never been a more important time to have your cash flow sorted, if you like. Times are tough, and we need to know that we've got those reserves and those buffers in place, and also for companies that are applying for grant funding and so on via eScalate and other programs, often providing forecasted revenue or P&L and so on is a requirement as well. So hopefully you'll get a lot out of today. Tony's going to be talking for about 30 minutes or so, and then there'll be lots of opportunity for questions. So no question is silly, no question is, don't feel afraid to put your hand up or put something in the chat box. I'll be monitoring those questions, and I'll interrupt Tony in his flow if I think that it's pertinent, but otherwise we'll leave stuff to the end. But at this point, I'll hand over to Tony to introduce himself, and thank you again, Tony.
Okay, thank you very much. I'm Tony Hobbs. I'm Managing Director of Chapman Robinson & Moore Accountants, and my speciality is actually business development. I run the business improvement program here at CRM. So this is forecasting and cash flow is something that I am quite passionate about. How I'd like to start this, I'd like to start this with a challenge. Now, in the good old days when we all used to sit in the same room together, this used to be a bit more fun because I used to actually wave a check around which didn't have anybody's name on, and I used to say to people, who would like to take £1,000 off of me? So that's the challenge, is who would like to take £1,000? Now what you have to do to get this £1,000 is I'm sat in my office. I have a good friend of mine who lives just up the road, and if I was driving from my office to his house, I would allow 10 minutes maximum to put my car on his drive. And my challenge today would be to anybody there who wants to come to my office and drive to his house in under 30 minutes, I'll give you £1,000. Now assess that as a business opportunity. You know what the income is? The income is £1,000. You know what the costs are. I've said it takes me 10 minutes. So I drive a Volvo, so I don't go very quickly. So you're working that it's going to be less than 10 miles. So you're talking about £4 or £5 maybe costs. So a good profit margin. Relatively low risk, you don't really have to do very much. It sounds like a good business proposition until the point when you ask me for his address and I say, I'm not telling you. Then all of a sudden it goes from looking for a fairly good business proposition because the income's certain, the costs are certain, low risk. So all of a sudden, it's just pure luck that you might drive from here and within the radius of 10 miles, land on his drive. And you're probably going to turn around and say, I'm not interested now. Because you would simply be judging everything on luck. You would be relying on hope and good fortune to get where you want to be. And you're just not going to do that. If you don't know your final destination, how do you know how to get there? And how do you know when you arrive? Now, the issue with this is if you are running a business without a proper plan and a proper financial forecast, that is exactly what you are doing. You are trusting to luck that you're going to get to a final destination because you may not even be sure what that final destination is. And proper financial forecasting is your business roadmap to success, to tell you where you're aiming to get to and how you're going to get there. Now, ordinarily, this is important in business. Where we are at the moment in a difficult climate, it's absolutely vital. If you haven't got a proper plan, a proper strategy to implement that plan and the financial forecasts to back it up, then you really are taking a huge risk. Okay, so that's the sermony bit. That's why I'm telling you that you should be doing all this stuff. And you're sat there saying, yeah, that's all very well, but how do I do it? This all looks quite difficult and complicated. What I would say is take this approach, and this is the approach I always take with business planning with clients. To start off with, Let's not think about any numbers specifically. Just visualize. Now, this will work for either a brand new startup business or an established business, and I'll try and sort of fit it into both. Just visualize where you want your business to be in 5 years' time. Just however you want to visualize that, draw a picture in your mind, get a picture in your mind of how you want your business to look, where you want it to be, what you want its image to be, how many people you want there, what you want the whole thing to look and feel like. And think of that in 5 years' time. Think about how much you'd like the business to be turning over, how much money you'd like to be making, how much you'd like to be taking out of it. And as you build up this picture in your mind, you need to start writing all these things down and jotting it down, and think very much of what you want your business to look at in terms of your brand and your image and everything like this, because this is all part of your business planning. And get something down on paper and start to look at it and look at it. Okay, well, that's where I want to be in 5 years' time. And now look at where you are now. Now, what you've got is you've got a gap. You've got a big gap there. And what you've got to think about is how you're going to fill that gap. And this is where you start building up your business plan and your strategy of what you need to do through years 1 to 5 to get yourself from where you are now to where you want to be at year 5. So you've got your final destination, you've got your goal at year 5. You know where you are now. So you build your financial model to fill that gap between years 1 and 5. Now, in doing that, you start off by look at your first year to start off with, because what you're going to do is you're going to build a detailed financial forecast for year 1. And then years 2 to 5 will be an extrapolation of that to a large extent. You can try and get quite an accurate forecast for 1 year ahead. As soon as you start going 2 years, 3 years, 4 years, it becomes a lot harder. So we make a big focus on year 1 and look at what you're going to do and what you need to do in year 1. Now, if you have access to financial forecasting software, that's a big help, because it does make life a lot easier. But if you haven't, then you're going to have to get your head around Excel pretty quickly. And you can do it all in Excel. That's how traditionally it was done for an awful long time. But to say, if you do have access to financial planning software and forecasting software, it does help. But get yourself set up with a basic Excel spreadsheet. And what you need to set up within that spreadsheet is you need to have 3 distinct tabs. You need a profit and loss, you need a cash flow, and you need a balance sheet. And you need to keep a very clear distinction in your mind between your profit and loss and your cash flow. They are 2 distinctly different reports that have different functions, and they very often get mixed up. Very often when I'm looking at people's business plans, the profit and loss and cash flow is all muddled into one. That does not work. You have to separate it out and have 2 different reports. So just keep that in your mind. We then start by looking at the profit and loss. So how do we do that? So split your profit and loss up so that you've got it split over a 12-month period. Start with what you know. If you've got an existing business, you know what your current overhead costs are, and you know what you're going to need to have as additional overhead costs on each month. If it's a new startup business, go back to what we were just saying about, what your vision is and what you need to set up. Think about what you actually need to have running operationally. And we're only talking about your operational costs here. Those are the costs that allow you to trade on a day-by-day basis. Things like your salary, your rent, your light and heat, travel costs. Well, if you have them these days, a lot of time we don't go anywhere, but it used to be quite a major cost. Think about all those costs, and then what you need to do is start allocating those in to your profit and loss account into the months in which they will fall. And some will obviously fall in every month. You'll have some costs that will just repeat every month. And build this up so that you start to build up into your spreadsheet, and assuming that you're working on a spreadsheet. So you've got all your costs in each month. And again, as I say, just operational costs. We're not talking about any of the structural or fixed asset costs. They will come in later, just purely costs that are related to your trading. Get all those allocated in over the first 12 months of our forecast. Apply an indexation in months down the line where you think there could be some price increases. Consider when new expenditure will have to come in during the year as you take on new activities or you ramp up your activities. Always remember to put in what you need to take out of the business as well, whether you're taking it in salaries or dividends or both. And this is quite an important point. If you are intending to use dividends, put them in your profit and loss forecast. I know they don't belong in your statutory accounts, but if you leave them out, then you're missing out what potentially is quite a big sort of cost element of your operations. So make sure that they go in. And once you've done that exercise, so what have you got? What have you then produced? So you produced 12 months worth of costs. What does that give you? That gives you a value for your break-even sales level, because the quantum of those costs will be telling you what you need to do each month just to break even. But you could still be losing cash. So just keep that in your mind as well. So once we've got those operational and overhead costs built in, the next thing to do is to look at sales. Look at what you think your sales line is going to be. And if you're in a business that is in any way involved in manufacturing or a process, the direct costs are involved in those sales as well, so that you can define what your margin is. Now, when you're looking at this, always err on the side of caution. Always be extremely pessimistic with what you're doing with your sales. Very often people go the opposite way around. Be as pessimistic, be prudent, because all the time that you're doing this, you're building in a safety margin. So for instance, let's consider that we're looking at a brand new business and you're setting yourselves up and you're thinking that you're actually going to start generating sales in month 2. Okay, well, that's good. Put them into month 3. Build a margin into your forecasting all the time. It's much better to go in that direction than the other. If you come in, you see very often people will put quite a large volume of sales in their first month. And when you start talking to them about it, it's never going to happen like that. It's not going to work like that. So be very prudent about where you're putting your sales in and start populating your spreadsheet with your sales and your direct costs at the top and putting those through. If you have an established business, look back at its historical patterns for sales and pay attention to those, because they very often will sort of repeat themselves, and keep those in mind. Allow for seasonal variations as well. Now you may have a business that has seasonal variations just by nature of its activity, but there are also other seasonal variations to take into account. And as for instance, it could be as simple as that you're going to have to allow, especially with a small startup business, you're going to have to allow that in the summer months, you're going to have staff taking holiday, you're going to have people away. You may need to bring down your sales forecasts in those months simply because you won't have the capacity there. Allow for that in your forecasting. And again, the other one to always look at is, I'm looking at forecasts, and you see people think they're going to make as much in December as they do in every other month of the year. Well, unless you're in retail and hospitality, you're probably not, because December is a 2-week month to all intensive purposes for any business that's not in those sort of sectors. So factor that in as well and look at it, as sensibly as you possibly can. What you often see with forecasting is that people, especially in early stage businesses, they'll have a small level of sales in the first month, and then the second month it ramps up, and then it stays exactly the same all the way through. That's not realistic, and it doesn't work like that. So you need to be as realistic as you possibly can. Once you've got that sales level in, and you put them in for all the 12 months, and you've got your direct costs, if they're applicable, in your margin, now go back to your overheads and make sure that your overhead costs reflect the increase in sales that you're predicting, i.e. make sure that you have the capacity within your business with the costs that you've got to support the level of sales that you're predicting. Now, with your overheads, you really need to think about taking these into 3 categories: fixed, and that could, for instance, be something like rent, and I would say a lot of the time wages, where that's going to be a constant every month, pretty much regardless of what the activity is. But many others will fall into what you call a semi-variable capacity. So there's a fixed element in them, but they do also go up as your sales activity increases. So you've got to allow for that. And ones on those would be things like your telephone costs. If you're busier, then the likelihood is there's more telephone activity. Your telephone costs are going to go up. Your travel costs could go up. Your stationery, it's silly things like this that you just need to link those into your sales and make sure that you're lifting those as you go along. And you'll have some of them that will be purely variable as well. They will go up and down regardless of what's going on in the rest of the business. So you need to get this mix, and so think about your overheads and your fixed, semi-variable and variable, and make sure that the capacity that you're forecasting is right for what the level of sales that you're doing. And if you do have a business whereby you have direct costs against sales, look very carefully at your margin, especially if you've got historical information. And if in the past your margin that you've achieved is around 25%, don't put 30 in your forecast unless you can justify why you're changing it. And if it's a new business starting up, this is an area you need to spend a lot of time on. Margin is really, really important, and you need to get that right. You need to make sure that you're utilizing your margin as much as possible. And when you got to this point, so you've got a whole picture profit and loss for the first 12 months, now you need to go in and you need to do some sensitivity analysis. Now, what I mean by this is go in and look at it, and you've been as careful and realistic as you can. Look at it and say, well, what actually happens if turnover is 20% below what I thought I'm predicting, or 20% above? Make sure you go in both directions, because obviously 20% below, you can see the implications of that. You know, that's going to be a problem in terms of your costs and in terms of your cash. But it can be if you do better than expected as well. You need to know the implications of that. There are many profitable businesses that in early stage go out of business because they run out of cash, because they're, the horrible term, over trading. So you need to look in your sensitivity analysis, which is easy enough to do in Excel. And quite often what I will do is take this out into a separate tab altogether and play around with the numbers in there. It's sometimes referred to, and it's being referred to a lot at the moment, as right sizing your business as well. When you get different changes in your level of sales, and you do need to look at this, you know, quite carefully. So we've now got our profit and loss forecast. So that's great. But what you really have to remember is that old saying is that cash is king. So making the right level of profit is important, but generating positive cash flow is absolutely crucial. And this is where you now have to start working on your cash flow element of your forecast. And this is I can't stress how important this is and how important it is to get it right as well. One of the things I would say, and a common error I see with cash flow, is to do with VAT. If you're dealing with VAT, understand the difference between your profit and loss, which will show everything net of VAT. You don't bring VAT into your profit and loss. But in your cash flow, everything is gross, and you have a separate line for your VAT payments or refunds. And the implications on your cash flow on this can be quite dramatic. So make sure you get that clear in your head. And within your cash flow, you're including VAT where applicable. First line on your cash flow, start looking at what you think. You got your overheads in there, so that's easy. You can put those in. Just assume that you're getting no credit at all. If you're an early stage business, the chances of anybody giving you any credit is pretty slim, and it's best just to assume that you're going to have to pay for everything up front. So the overheads from your P&L will probably fall into exactly the same month in your cash flow. As I say, your chances of getting credit are fairly slim, especially in a new business. Then look at what you forecast for sales, and look at when you got those forecast sales in your P&L. Look at when you think they're actually going to come in. You're actually going to get the cash, because unless you're in, for instance, like a retail type of business where people pay cash up front, especially if you're in B2B, you are unlikely to be paid. Sorry, B2B, I mean business to business. You are unlikely to be paid straight away. and a lot of people want credit off of you, and especially when you're early stage business, when you're trying to build up relationships, they will take advantage of you as well. So be clear on when you think your money is going to come in, and be careful how you put them into your cash flow. And another thing here is define your days credit terms very carefully if you are giving credit to people. If you say to somebody that you're giving them 30 days credit, is that 30 days from when you deliver the goods or services? Is it 30 days from when you deliver your invoice? Or is it 30 days from the end of the month in which they put the invoice in their books? Be clear on this, because it can make a big difference as to when you get paid. In the latter case, if they're taking that 30 days from the day from which they put that invoice onto their books, the end of that month, you're talking 60 days before you get paid, realistically. And when you put the amounts into your cash flow, if you're saying that your first sales come up in month 3 and you're giving 30 days credit, you need to be clear on these terms, because that's going to determine whether you're going to show that income for month 3 coming into month 4 of your cash flow or month 5. And again, it makes a big difference. So you need to be clear, very, very clear on what your credit terms are, what you're offering. Communicate that to the people that you're selling to, and then be careful about how you put it into your cash flow forecast. In your cash flow forecast now, you also need to bring in, when I was talking about P&L, and I said just stick to operational expenditure, don't think about structural plants and equipment and so on. That has to come into your cash flow, and you have to bring that into the months in which you believe they're going to arrive, and get that in and make sure that you've covered all of that. And the other thing, please don't forget our friends at HM Revenue and Customs. They get so upset when they're left out. You need to pay them. I've already mentioned the VAT. You need to have that VAT line in. Also, remember, if you're employing people, PAYE, you're going to have to be paying the PAYE. You need to reflect that properly into your cash flow, especially these days with real-time information on PAYE. There's not, in the old days, you could pay it 19th to the next month and you always stretched it a little bit. You don't get away with that now. So make sure you put that in. Make sure you also put in, if you're building up a nice profit forecast, which is actually showing you as a profit, you need to allow the fact that you're going to have to pay tax on that profits. Now, obviously, this is not going to fall in year 1, but you need to be taking it forward into the following years of your forecast to make sure you're allowing for that. And make sure, if you are using this mixture of salaries and dividends, that you're taking into account there as well what the tax is, because your cash flow, it has to show everything. Once you got to this position, you got your profit and loss, you got your cash flow, you need to forecast your balance sheet as well. Now, this is often overlooked. It's often ignored altogether. The balance sheet is a very, very important tool in your business forecasting. Now, if I say it is vital, your balance sheet forecast for the end of your first year, when you're looking at what your balance sheet is going to look like, if that transfers to real numbers, that's going to be the view the outside world takes of your business. People like any potential investors that you want to bring in, any lenders that you have, the bank or whatever, and suppliers. If you're going to people asking them for credit, they will be looking at more at your balance sheet than they will at your P&L. So if your forecast balance sheet for the end of year 1 is looking weak, you need to go back in and look at your forecast again and look at what you've done in your P&L and your cash flow, and where you can make changes in your business strategy. Now, I'm not talking about just making changes on paper. I'm actually talking about making changes in how you're running the business. And this is another important thing. Making the change in your financial forecast is one thing, but you actually have to implement that. You have to bring that in as part of your strategy and make it work. And this is what I was saying right at the very beginning, right at the start. The financial forecast, it's your roadmap. It's a tool to be used for running your business. It's not something that you do at the beginning because everybody tells you should do. Then you put it in a drawer and never think about it again and go and get on with your business. If you do that, you're trusting to luck. And the balance sheet, as I say, it's often ignored, but it is absolutely vital, and it will give you so much information. And this is, again, where you need to do sensitivity analysis and scenario planning. So again, when I talked about doing the sensitivity analysis within your profit and loss, when you do that minus 20% on your forecast sales, look at what it does to your cash flow, look at what it does to your balance sheet. And that's got to be something that you take forward with you, so that if you do have that happen, as you go through in the business, you already know the implications of that, and you will already thought about what you need to do to adjust that and to change it. So the balance sheet is incredibly important, as I say, especially if you want to, when you put all your forecasts together and your cash flow in particular, if you're looking at your cash flow and you're seeing 6 months down the line, you've got a big capital purchase to make, or it's been slow because it's been through the summer months, and you're looking at that thinking, well, actually my cash flow there, I'm going to need some extra help. If you approach your bank and you say, look, I've got my business plan and my forecast here. This is showing that 4 months down the line, I'm going to need a facility, be it an overdraft or an invoice discounting facility. I'm going to need a facility. I believe I'm going to need this much, and I believe I'm going to need it for this number of months before I can actually bring it back. If you approach a bank in that way, they're going to be far, far more receptive than if you phone up on the Monday and say, oh, I need an overdraft and I'd like it by Wednesday. That'll be a very short conversation. They don't like that sort of surprises at all. So the forecasts are absolutely vital for this type of relationship as well. And if you're looking to investors, for people to come in and invest in your business, if you can show them that you've got 5 years forecast with a very detailed 1 year forecast, you're going to an investor and you're saying, this is how much I want, this is how much I'm prepared to give you, this is what I believe my business is going to do. Very often I see people go into investors and it's a very vague, I need some money, or they come up with an amount, but then they can't substantiate what that amount is for. Investors want to know what you're going to be doing with that money, what it's going to be used for. And investors will not be keen if that money is purely going in to satisfy a working capital requirement. That's what the bank is there for, or should be there for, with an overdraft or invoice discounting type facility. These are all the things that your forecast should be telling you and allowing you to approach way in advance of actually needing the money. So another really important thing about your forecasting is that once you've got all this in place and once you're comfortable that what you've got is a proper forecast, it doesn't end there. You need to have a system set up so that you can, each month, you can produce management reports and accounts. And then each month you update your financial forecast. So you put your actual figures into month 1, where you had to budget it. That will ripple through your whole forecast. It will update your cash flow. It will update your balance sheet. And it allows you to do a review every month where you can look at it and say, based on our actual results, what's happening now? This is where we think we're going to be at the end of the year. This is what we need to do. Do we need to tweak our strategy? Do we need to change? And as part of this process, when you set up your forecasting, you should also set up your key performance indicators, or KPIs, for the business. Now, my suggestion would be that you don't have too many of these. Between 4 and 6 is a good number. If you have too many, it all gets a bit foggy about what you're trying to measure, but you need KPIs that are specific to your business and you understand. Now, there's often KPIs are often, turnover is often one, cash is very often one. If you're measuring cash as a KPI, don't measure it in terms of how much cash you got in the bank. Measure it in terms of a cash runway figure. And what I mean by that is measure it in terms of how much cash to have to cover your operating costs. So say, for instance, you decide I want to be able to cover 6 months operating costs with my cash at any one point in time. You measure your cash runway KPI each month, and when that falls below 6, that's an alert. That's something that you need to do something about. Measure it in terms of, well, I just want X amount in the bank. I don't find that particularly helpful. A cash runway is a much more helpful way of measuring it as a KPI. But you need to be looking at those KPIs each month. You set them right at the very beginning. When you put your actual figures into your forecast each month and update everything, look at what it's doing to your KPIs. So you can measure your KPIs as you go along month by month, and also look at them as where you're going to be at the end of the year. So the forecasting is a very active tool within your business, and it's something that you have to be referring to at the very least once a month, if not looking at it on a much more regular basis. In my business, well-established business, I'm checking certain of my forecasts every week, and sometimes several times a week. I might only look at them for 2 or 3 minutes and see that I'm on target for where I want to be, but I check it. And if I'm not on target, I'm immediately going back and talking to the team saying, hey, we seem to be off a bit on this. What's happening? What's going on? Sometimes the people look at the business plan and they've ended up with quite a clunky document, and they actually find it quite sort of difficult to maneuver around. Keep it as simple and clean as you possibly can. But if you do find that a problem, think about using something called a one-page plan, which is one simple A4 sheet of paper in which you summarize the main aspects of your business plan and what you're trying to achieve and your KPIs for each month. Now, I've got a number of clients who they use a one-page plan and they'll actually pin it on the wall in the office, and they'll leave it there for everybody to see, and they'll record what's happening each month. And it's just a nice visual reminder rather than having to plow back through a complex spreadsheet all the time just to see where you are. But it's this constant referral, constantly using your financial forecasts as a tool to make your business decisions. And coming right back to the very beginning, what we started talking about, we were saying about this 5-year horizon, and we were filling the gap and looking at where you want to be in 5 years and building a strategy from that. And the business strategy, don't get sort of carried away with this. As far as I'm concerned, the strategy that you're running in your business, it's a way of implementing what you need to do to get from day 1, where you are now, to the end of year 5. And that strategy reflects what's going on in your financial forecasts, which means the strategy is also up for review all the time. Don't think of something as being set in stone and that's it. It can't be changed, especially with a new business, with an early stage business. You may well find that a lot of the things you look at in early days, you've either been inaccurate or you've just simply got them wrong. They're simply wrong. And you need to have the courage to go back and say, okay, this is not working. This is not giving us what we need, and it's not taking us towards our ultimate goal. We need to revise. We need to change. That doesn't need to be fixed points during the year. I've heard people say about, well, we only review strategy once or twice a year. You can review your strategy whenever you want. And if you need to implement a change because there's something going wrong, the sooner you implement it, the better. It's from your financial forecasts that you pick up all this information, and it allows you to make these changes. Now, in terms of where we are now, in terms of we've got this forecast for year 1, I said earlier on that 2 to 5 are more of an extrapolation, which they are. All you need to do is make sure that you're extrapolating forward the right indexation on costs, for where your costs are going to go up, that you keep in the future years, you keep matching your overheads into your sales to make sure you're forecasting enough capacity. And then in those future forecasts for years 2, 3, 4, and 5, what are the big additional costs or investments that you're going to need to make to get yourself to where you want to be at year 5, and bring those into your forecast as well. So very often those sort of investments are more concerned with your cash flow forecast and your balance sheet forecast and your P&L, but you need to bring them all in. And you need to make sure that everything is linked. So every time you make a change in your year 1 forecast, it ripples all the way through. I mean, you can do that. You can build this up in Excel fairly easily. If you do have forecasting software, it's a lot easier because that's exactly what it's designed to do. But you must make sure that you're allowing that to ripple through all the time. So you're always looking at where you are at the end of month 12 in your first year, or your next year as you move down the line. But you've also got an eye on what's happening towards year 5. Okay. And I talk about 5 years because I like 5-year cycles. I tend to, when I'm working with businesses, then say, let's have a 5-year plan. And that's what I do in my own business as well. I have a 5-year plan. I work through my 5-year plan. I get to the end. I then have certain decision markers that I make, and then I reset my 5-year plan, and away I go again. So I'm always got 5 years it's long enough, but not too long. 5 years goes very quickly in business, but it's long enough to give you that little bit of a stretch that it gives you some planning. So I like the 5. I don't think going beyond 5 years. Some of the companies I work with, some of the bigger companies, we do have longer 5-year forecasts for particular things, but it's all a bit Grimm's fairy tale by the time you get there. It's all, anything can really happen.
Tony, we've got quite a few questions here, and I know
Okay.
I know you prompted me to think of some things as well. Could we start to go through some of those? Would that be okay?
Yeah, of course. Yeah.
Okay, so we've got one very valid question. Well, they're all valid, but with an established business, how far back in years would you suggest you look to identify trends in sales and costs?
I wouldn't go back that far. I tend to look about a sort of 12 to 18 months, and how I look at the trends and so on, I tend to put those into graphs. So sometimes I go back further, but you could go back, I suppose, from what I've just said, is you could do everything. You could go back on a 5-year, but you got to look at it that the further you start to go back, your business has developed and changed, outside environments have changed. So I would 12 to 18 months would be my main answer to that.
Perfect. Okay. And then we've talked about financial forecasting software. Are there any packages that you would particularly recommend?
There are a lot out there. The problem with most of them is the cost. Now, the one that we work with is one called Futurely. Now, the reason we like, I'm not saying it's the best one out, but the reason we like it is when we work with clients, we can give clients access to it. So we set up the forecast and work with the client. We can give them access in. So what it means is that the client can log in and work on the forecast as well as us, and we can work on it together. But I mean, there are a lot out there, but for an early stage business, I'll be very, very careful because they can be quite expensive. And also, if forecasting is something that you haven't really quite got your head around yet, they can be a bit daunting. You may well need somebody to sort of work through it with you.
Okay. So would it be better to start off, as we've talked about the famous Microsoft Excel, would it be better to start there to familiarize yourself with your, the data that you need to input?
Yeah, I'd say I probably would, unless you've got somebody you can work with that has access to software. But make sure, if you do that you can get hold of the information if you need it, because I've come across people before, they work with other organizations and they built up these wonderful forecasts, but then when they've come to go off and work on their own, they've been told no, we can't give you it's our software, so you can't use it. So you don't really want to get in that situation.
You don't. So how do you suggest, this is another question, how do you suggest handling a negative balance sheet because of the carried over losses compounded by the accrual view rather than the real cash in the bank?
Okay, well, what you need to look at that is you need to, if you're just talking about negative losses, negative reserves, again, what you want to look at is in terms of where you move from and to, because if that is a situation that is gradually getting better, so your balance sheet, so what your forecast is at the end of the year, you're still going to have negative reserves, but the balance sheet has overall improved, then you're probably okay. Because what happens when I talk about sort of credit ratings is when you file a balance sheet and they look at it, and that's a benchmark that they use. So when you file the next one, if you've moved in a positive direction, that's a plus. If you're talking about early years, it's quite, a lot of businesses do make a loss in the early years and end up with negative reserves. What you got to look at in terms of when you're doing your forecasting forward is what are you actually asking for, and what are you going to be using that balance sheet for? So if you've got a level of investment that's already come in, it could be well that you have negative reserves, but your net current assets are still a plus. And that's the really important one, because that's the one that often people refer to about the liquidity of your business. So if you've got that as a plus, but you've got negative reserves down below, then that's not necessarily an issue as long as you can explain it. And again, it's about showing that your trends are going in the right direction. And this is why in your first year, if you're forecasting at the end of the year, you're going to have made a loss overall and you've got negative reserves, then that in itself is not a problem. It's how you deal with it from that point in, and what your forecasts are showing is going to happen afterwards. If you've got a deteriorating balance sheet position, well, then you've got to go back to, you've got to disassemble your balance sheet and look at why, look at what's happening. Is it just a level of profitability? Is it poor cash management? And you have to fix those root cause problems to repair the balance sheet.
Okay, that makes sense. For a business, so the example here is a business that creates and delivers bespoke learning and development programs for hospitality. And
Yep.
we know how the hospitality sector has been decimated throughout the COVID pandemic. So what advice would you offer for dealing with a fundamentally changing business climate?
Okay, well, if you've got a business climate like that, I mean, this is where your sensitivity analysis goes in. The first thing you got to look at is to be brutal, is how long can I survive on what I'm doing now, and how long, before do I think the market's going to come back? If the answers on those questions, I think you're looking at a market that is not going to come back, or it's going to take too long. You haven't got the reserves aside. What's your alternatives? Can your product be modified and pushed into a different market? Is there a different way of presenting your product? But that's the core thing, and that's the big issue at the moment, because with hospitality, it's an interesting one, because normally at this time of year, hospitality, they're looking forward to their busiest time of the year and to run up to Christmas, where a lot of them will make the bulk of their profits. We just don't know. We just don't know at the moment. There's been some more not so good news coming out today that looks like there might be some more restrictions on hospitality going forward. So again, you've got to look at your sensitivity analysis and say, okay, well, let's wipe out this Christmas season. Let's say it just doesn't happen. What is that going to do to my business? Where am I going to be in 2 to 3 months' time? Have I actually got the resources to survive, or do I need to actually look at switching into a different market? Can I have 2 parallel markets running at one time? With an educational and training type of product? Obviously, I don't know anything about it, but my guess would be you probably can tweak, and you can probably get it into a different market area and look at doing that. But you need to be thinking about it well in advance, because obviously you can't switch overnight. And you do just have to look brutally that unfortunately, if you're dealing in the hospitality market at the moment, it's by no means certain when it's going to come back, and it's whether it comes back in time for your business.
So it's looking at your cash reserves and understanding whether they can keep you afloat until that sector comes back online. But really, you probably ought to be thinking about pivoting.
Cash is always the absolutely crucial one. There are other aspects, but cash is a crucial one, because when you run out of money, you have an issue. And the other thing you need to be looking at doing now, and this is why the forecasting is so vital. And as I was talking about the crash runway, how long can I keep going before I hit the buffers? And if you go to your bank and say, look, in 3 months' time, I'm going to run out of money, and I'm dealing in the hospitality market, and what I want is I want an overdraft facility to sort of carry me through these months. Unless you're showing them where you believe you're going to come back into a positive funding situation, they're not going to help.
Yeah.
The banks at the moment are as nervous as anything. They've got all of these CBIL loans out there, a lot of which they think they're never going to get back. Now, although they're underwritten by the government, in the first instance, the banks have to go and try and pull these back in. The banks are nervous. They are very squeaky. They are not going to be quick to lend and help. And if you don't go them with a very firm proposal, financial forecast backed up by a strategy which says, I believe that I have this problem over the next 3 months, but what I am doing is this, this, and this, and I will be back into a positive cash flow position in months 4, 5, and 6 afterwards. If you can present that to them, then you've got a fighting chance of getting some help.
Yeah.
If you don't, well, I wouldn't even waste your time asking them.
So it's that preparation.
Yes.
Good question here. So what are the best metrics and ratios for balance sheet interrogation?
What was that? Sorry, the best metrics for the balance sheet?
Yeah, best metrics and ratios for balance sheet interrogation.
Okay, well, it does depend to a degree on your business, but the metrics for balance sheet interrogation: debtor days, how many days your debtors are paying on, stock days, if you carry stock, how many days it's taking for you to convert your stock from actual stock into a sale. Obviously, the cash runway is one that I've mentioned before. On the overall balance sheet, it's looking at your net current assets figure. So that's a very, very crudely, that's your debtors, stock and cash against your short-term current liabilities, and making sure that that's a plus, because that's your liquidity factor. And if that goes negative, what that's effectively saying is you can't meet your short-term liabilities. And in the current climate, anybody looking at your balance sheet on that is going to look at it and say, well, we're not going to be offering them any credit. So that's what I would say is debtors days, creditors days as well, to monitor when you're paying your creditors, because if that starts to slip, that's an indication that there could be something else. It's no good thinking, oh, you know, my cash metric is good, if your creditors days is actually saying, well, your cash metric is good because you're not paying people.
Yeah.
And this is another thing, especially in this climate, you need to consider all the stakeholders in your business, which include your suppliers. You got to think that while you're thinking, well, if I don't pay them for another 30 days, then I'm benefiting from that. One of your customers is having exactly the same conversation about you. If we don't all keep this cycle going, it will stop. So for balance sheet metrics, I would say, debtors, creditors, stock, cash runway, your overall liquidity.
Fantastic. I want to get through the delegates' questions before I ask my own, but you have prompted me to think of a few. Are there any online business plan templates that you recommend? I mean, there's lots really, aren't there? Are there any that you found are particularly useful?
No, we don't use online templates. The routes we would go is we either do something bespoke on Excel, or most of the time what we do is we use the package that I referred to before that we've got in-house, the Futurely one. The other thing about using the bespoke packages, and this is quite a big thing these days, is a lot of them will talk directly to your software, accounting software.
Okay.
So what it means is if you've got something like, and I'm not on a sales pitch here, but if you're using something like Futurely and Xero, we have a lot of clients that use those too. At the end of the month, you can automatically update your forecasts with your actuals from Xero. You don't have to do a thing other than press one button.
Yeah.
And instead of the days where it used to be, you had to manually sort of type everything in. There are a lot of online templates out there. I'd be a little bit cautious about using them. Make sure you understand how they work. The advantage of having something in Excel that you built yourself is at least you understand how it works.
Yeah, no, that makes absolute sense. Just going back to the balance sheet interrogation before, how do you get the debtors and creditor days from the balance sheet if they're always rolling at roughly the same amount?
Well, what you do is you need to, for the debtors and creditors days, you need to have rolling 12-month numbers. So you have to have your rolling 12-month sales figures. So you have to sort of change it every month to calculate the ratio from there, and the same with the creditors. So there's a little bit more work in doing that. You can't just take the figures directly from your management accounts, but most financial accounting packages will allow you to pick a range for that quite easily and just pull the information out. So that's how you set those up. And then my suggestion is that you track your KPIs every month. So you record them every month and put them down. And what I tend to often use Excel for that. And what I often do as well is I put them into graphs. The reason for this is that you, even as an accountant, sometimes I'll stare at a block of figures and just think, oh, I can't see a bloody thing in here.
It's number blindness, isn't it?
Yeah. Whereas if you've got a graph with nice coloured line on it, and I can see that my debtor days are going up like that, I think, oh, that's not right. That's not good. If I got a straight line going along like that, I think, yeah, that's okay. I can live with that. It's easy enough to do with Excel, but put things into graphs, whether you do line charts or bar charts, pie charts, whichever one.
Yeah. Yes, they've got that visual side. Yeah.
Visual is really important, and we do this a lot when we're presenting reports to clients. And again, the forecasting software, they do these reports. I don't always like the ones they do. Keep it simple. Keep it to things you understand. Sometimes their reports are just too fussy and complicated. And when you're actually trying to work with them, you can't draw out that vital information that you need. So keep it all really simple, just simple graphs of your KPI metrics.
Okay, perfect. Well, that's I've got a couple of questions actually that you've made me think about. With a seasonal business, say for example, you know, their biggest takings are during the summer months. In terms of developing a cash reserve, would you take money out of the business and put it into a separate account?
Well, you can do. Sometimes that is quite sensible, because it's just like, it's good cash management if you just allow it to sort of build up in that one account. You know, there is the temptation that you don't manage it quite as well as you should. It does come down to what your cash flow is showing. And I am quite a fan of, you know, if you've got specific, you know, you're having your really good months, and say for instance VAT, that's the classic one, and you know that you're going to have a big VAT bill at the end. I'm quite a fan of saying, okay, well, that VAT money is not mine. I know I'm going to have to pay that at some stage. I'm going to put that over here in this account, so it's not going to get dragged in to all the everyday spending. So yes, it can be quite a useful discipline.
Okay, wonderful. And we talked about including cost increases in forecasting. Would you include price increases as well in terms of your revenue?
Oh, yeah.
Yeah. So
I tend to, as all part of the scenario planning, will, you know, bringing in cost and price increases. The other big one to remember is things like salary increases, budgeted in salary increases for your staff when you think you're going to give them, and put them into your forecast. Even if you're thinking, I know a lot of businesses at the moment are saying we're not giving salary increases, but still factor them in, so you've got it in there. If you decide later on to take them out, then that's fine, but keep factoring them in.
Okay, wonderful. And then the last one from me is, in terms of forecasting, we've talked about that first year is the really granular detailed one, and you try to get it as accurate as possible. For those follow-on years, in terms of revenue, for example, would you go through each individual product line, or would you apply an uplift in terms of, you know, growth? So we're going to apply 10%.
What I would tend to do is I would tend to track on individual products and services lines, because what I'm interested in doing is looking at how you forecast going forward is how you forecast historically. So if you forecast it with individual lines, and what you find is certain lines have gone very well, certain lines haven't, certain lines you've been able to forecast very accurately, others you're always out. That helps you to build your forecast going forward. And what you can often do is you can have the individual lines in, you can apply one overall, let's say we're in year 2 and we're saying we just want to see a 10% increase overall throughout the year. So you apply that increase and just apply it blanketly across every cell, and then go in and look at it and say, well, actually this particular product is actually done a lot better. This is running at 12%, so we'll put this one to 12. But this one down here, not running so well. We were forecasting that we were going to do 200,000 last year on this. We've only done about 120. So we need to bring this back down because we're not getting the increase on there. And then you can start the bigger conversation is actually, well, if this product line is not doing very well at all, should we be not knock that one on the head and switch resources to the one that's doing better? Again, proactive decision making.
And you can, because you've got the data there. You've got the data
Exactly,
on which to make those decisions.
Yeah.
Tony, that's absolutely fantastic. I mean, every day is a school day, so I've learned lots. Are there any other questions from anybody? Anything else that I can pose to Tony? Because if not, we're going to wrap up 5 minutes early, which is always good. You can go and grab a coffee before your next activity of the day. I don't think there are, Tony. I mean, the questions that have come through are great, and clearly, you know, you've answered those brilliantly. So I think that's it. If nobody's got anything else,
okay.
The only thing for me to mention is obviously we have another webinar next week, the week after. You've got details. So we're talking crowdfunding next time. So we've gone from accessing finance to managing the finance within your organisation to now accessing more finance. So join us with Anthony D'Souza for crowdfunding mid-October. I don't have the date to hand, but Tony, thank you so much. That's been so useful.
No, my pleasure. I always enjoy talking about forecasting. I know I really do need to get out more, but it's what I do.
Well, you talk about it really well. I have been recording the session today. Oh, hold on, we have one. This might just be a thank you, but we have one chat. Don't want to go off. Where is it? Thank you very much. Thank you very much. Great session, really useful and informative.
Okay, thank you.
All right, thank you everybody, and thank you again, Tony. Much appreciated.
No problem at all. Thank you very much.
No worries. Take care. Bye-bye.
Okay. Bye-bye.